tilt the probabilities as far in our favor as possible. So the reason we're starting with credit spreads is they are already a high probability strategy. And here's why. Well, we'll take a look. The thing with credit spreads, well, let's just examine it. The thing with credit spreads is probability. The basic advantage of selling credit spreads is straightforward, because most options expire worthless. We'll sell options that have a high probability of expiring worthless already the moment we put on the trade. So if you're not familiar with a credit spread, I'll just go over it real quickly. And you know what? If you don't know anything, I think probably a lot of the people that are watching this right now do know a lot about credit spreads. And so there's two kinds of folks here that might be a little, wondering if they should watch this. There's the person that knows a lot about credit spreads and has been trading them. If you're in that category and you think that you don't have anything to learn here, please stick around. I've got some really good information. I think you're going to come away from this feeling a lot better about the strategy than you do right now, have a lot more confidence, and be able to increase your win ratio. And if you're in the category where you don't even know what I'm talking about, what the heck is a credit spread, stick around also, because even though it seems a little overwhelming at first, it's really not that complicated. And I'll explain what a credit spread is really quickly. You sell an option that is out of the money. So, if a stock price is $100 and you sell a call option for $120, that's out of the money. So the only value that option has is time value. And then, because you don't want to have unlimited risk, you buy another option very close to it. Say if you sell the 120 strike call, you might buy the 125 strike call, and that's your hedge, and your only risk is between those two strike prices. Now, if you're still thinking, well, I just didn't follow anything you just said, that sounds kind of weird, hold on a minute. I'll give you a picture. I'll make this really simple for you. But what I want you to understand right now is that there's three very basic advantages to our style of credit spread selling. So let's take a look at what those are. Advantage number one is sell. This seems obvious, I know, but I've actually screwed up on this several times. Sell in the opposite direction the stock or index is headed. So let me get my little pointer here. And we see that this is GS, Goldman Sachs, a little while back, and they weren't doing too well. The financials were having a rough time. So this is what Goldman Sachs did. So you've got this big, longer-term downtrend here. Then, it spiked lower and then recovered and kind of bobbled around here, but it's still making a series of lower highs and lower lows. So you have a longer-term downtrend and you have a short-term downtrend. And, it's recovered back up and then it's come back down. I mean, this is a really nice setup. From a technical standpoint, this just indicates the stock's going to stay weak for a while. So the way you do a credit spread is you sell, in this case, the $230 call, and then you buy the, in this case, the $232.50 call. That's a $2.50 spread. Because this strike price is closer to the underlying than this top strike price, this close one has more value. It creates an instant credit in your account. You get paid instantly. Cash shows up. It's the only strategy I know of that does this. It's just super, super cool. So, without going into too many detail, this thing bobbled. It actually broke above our lower, this downtrend line here. I thought we might have been in trouble, but we just hung out. And I'll tell you, if you're a little bit of a procrastinator in life, you kind of tend to let things go. You're going to really like this strategy because it popped up above this line but bobbled around a little bit and then crossed at this line. This is known as the finish line or expiration. Just crossed this, and then both of these two options expired worthless, and all that credit just takes permanent residency up in your account. It's pretty cool. So this is, if you're taking notes, I'm going to give you 3 advantages and I'm going to give you 3 twists. So advantage number 1 is sell in the opposite direction the stock or index is headed. So just write that down in your notes and we'll move on here. Okay, advantage number 2, sell a relatively short amount of time on the steepest part of the time decay curve to get theta or time decay working harder for you. So there's not too many things that are for sure in life, but I'll tell you one of them is that options time decay is always happening. It's happening 24/7. and all out-of-the-money options will expire worthless at some point. So what's interesting, and what I want you to take away from this slide right here, really, really important lesson, is that time decay with options does not happen in a straight line. So you see, this is 4 months out going to 3 months out, and the time decay curve is fairly flat. So you lose a little bit of time value, but not a lot. And then from 3 months out to 2 months out, it's a little bit steeper on the time decay curve, okay? And then from 2 months out to 1 month out, it kind of steepens up a little bit, but you'll notice this little bump right here. So just a couple of days before an option becomes front month, it kind of steepens up quite a bit. And then you get into this really unbelievably steep part of time decay right here is in the last 30 days. Now what we've found through a lot of experimentation is the perfect amount of time to sell on an option is about 10 days, which is about right here, to about, I'd say 10 days to about 21 days, out to about 3 weeks. And the reason you don't want to sell all the way down here on the steepest part is because you have to sell too close to the underline, and it's kind of dangerous. So the sweet spot right here, you can sell a good ways from the underline. You can still get a fantastic credit, especially if the volatility on the underline is high. And then you've got a very short amount of time, and every single day makes a difference. Keep in mind, say if we sell 10 days at a time, keep in mind 2 days of that 10 days is going to be a weekend. So that's just free time decay right there. And then you get down here to 0 when you have 0 time left, and that option just expires worthless. So for those of you that have been trading options for a while, I want you to think about a situation where you bought an option. You bought a put or you bought a call, and the reason you did is you're absolutely certain that this thing was going to just go crazy. You know, it was going to make you a ton of money. And you're patient, so you wait, and, you know, it bobbles a little bit in your direction, but then it goes a little bit away from where you want it to go, and, you know, does this and does that, and all of a sudden, you know, there's like 3 days left, and this darn thing's going to expire worthless, and you wake up one day and it has very little value. And then the thing just goes quietly into the night, and, you know, all your money went away on that speculation. Well, that's the way I started out. And when I saw what some of these options did, and I saw how much they increased in value, doubled, tripled, quadrupled, you know, when I first got involved with options, buying, trading, I thought my biggest problem in life was going to be what color my Mercedes-Benz was going to be. I mean, I thought I was just going to be rolling in money. And I thought, you know, working's for chumps. I'm just going to be an options trader, and I'm just going to make so much money. Well, what happened is just life, you know. I mean, even in the markets, they're so random. I mean, this happens, that happens, the stock bobbles around, it goes in the opposite direction. Boom, you lost all your money, thank you for playing, come again. And I got so frustrated, and I started wondering, you know, what is happening to all my money? Where is it going? You know, with all this options premium that's expiring, you know, what's happening? You know, is it just going to money heaven? Is it going into an incinerator somewhere? Is it getting burned up? Is it sprouting wings and going to money heaven? You know, what's happening? And it took me a long time, you know, maybe I'm a little thick, maybe I'm a little dense, but it took me a long time to figure out that the option seller is collecting all that premium. And then as I started hanging around more options traders that were smarter than me, guys that were pros, guys that ran brokerage houses, professionals that were in the game, I discovered that, oh yeah, we never buy options. Unless we're hedging a portfolio, then we'll do it. We'll buy them from insurance. But basically, if we want to make money, we sell options. Because basically what you're seeing right here, this time decay curve, look at it. All options, out of the money options, they expire worthless. Another way to say that is all time decay on options or all time value on options eventually goes away. Even if the thing expires in the money, all the time value goes away. So why not jump on the winning side of that trade and sell it instead of buy it, especially if you're doing it short term. So this is advantage number 2. Once again, you can write this down. It's important. Advantage number 3, sell call spreads above resistance and put spreads below support. In other words, the stock has to do something. It has to get it has to break some kind of a barrier to threaten your position. So this is an actual trade we did just not too long ago. And here you see this nice uptrend. So you know from technical analysis that Support once broken turns into resistance. That's exactly what happened here. So Visa broke the support line, hit it, retraced, went back down, hit it again, retraced. Then finally, some good news came out, and it really broke it decisively on really good volume. So then you have a breakout. Well, the breakout happens. Once again, breakouts retrace. Old resistance is now turned into new support, bounces off of it, comes down here, bounces off a couple times, now it's going up. So I'm sitting here looking at this chart, and this is an actual chart from our trading service that comes out every Tuesday evening. I just copied it exactly, didn't change anything for the webinar, and here's my comments. Visa has a strong uptrend in place and strong fundamentals to support it. We're looking for a little pullback toward that uptrend line, and that could help us get a good fill on a high odds put spread placed below support. So here this happens to be a $1 spread. So some of the popular stocks have $1 strike prices on them now. I think all probably optionable securities will have this eventually. But so we sold the 91 call and we bought the 90 call. And as you can see, there's just a handful of days left here until expiration. A little over a week, probably about 10 days. Now, here's one of the beauties of credit spread. So, the purpose of this particular advantage right here is to show you that you want to sell put spreads below support, call spreads above resistance. But here's what's cool about credit spreads. If this thing just keeps going on the path that it's going, this spread's going to expire worthless. We're going to get maximum profits out of that. If the uptrend kind of falters a little bit and starts to level off and goes up at a slower pace, we still win. We still get maximum profits. If the thing just all of a sudden decides to go sideways, kind of go dormant, can't muck up its mind, we still cross the finish line without this getting touched. We keep all the money. And the thing is even this thing goes down a little bit, which we're actually hoping it will to get a better fill on our trade. If it goes down and it touches this uptrend line again and then bounces, we still end up keeping all of our profits. So the only way that this can get threatened is if Visa suddenly decides, I'm just going to sell off completely, goes straight down, has to break support here, and then has to come down in order to threaten our spread. That's the only way that we can lose on this. So one way to look at that is the stock can only do one of 5 things. That's it. It can go up a lot, it can go up a little bit, it can go sideways, it can go down a little bit, it can go down a lot. And this scenario allows us to make money on 4 out of those 5 situations. So you can see why all other things being equal, you just win. Now what a lot of people do, and I think personally this is a little dangerous, but this works for some people, is they just put on these trades and they forget about them. And they just figure, 4 chances out of 5, I'm good with that. I think I'm just going to let this trade go. But I'm not comfortable with that. I think we need to put some more advantages in our favor. So this is where we get to the twists. So those are the 3 big advantages. Let's get to the 3 twists, and these are important. I want you to write these down. So those are 3 basic advantages that make credit spreads so attractive. In fact, just employing these 3 give you over an 80% probability of winning, and that's quantifiable. I can actually show you the probability based on the Black-Scholes pricing model and other options pricing models that show you your probability of winning. And that's for all the trades we do, it's in excess of 80%. But can we add some twists that increase our chances even more? What else can we do to really improve our odds? What can we do to make it better? And I think that's a good question to ask, no matter what you're doing, but particularly with your trading. So if the goal is worry-free passive trading, can we increase our odds even more? Twist number 1 is don't ever let a trade go to maximum loss. Set a stop loss to cut that loss in half. Let me show you how to do that. So here we are with our chart of Visa again, and I want to explain something. So if this stock suddenly did just, all of a sudden fall completely out of favor, Visa makes some horrible announcement and everybody decides to sell, and this stock plunges, and it plunges right through support, and it touches this sold strike right here. The stock price touches this sold strike. Option pricing theory, and that's one of the wonderful things about options, is they're based on a mathematical formula, so you can figure a lot of this stuff out. It's pretty cool. So options pricing theory tells us that if this sold strike is touched, it's going to cost us